Welcome to ET Money Makers. I'm your host Pallavi Arun Verma. In our commitment to grow your money to its full potential, we've invited experts from two different domains to tell you more about mutual funds and P2P lending. To talk on mutual funds, we have with us Mr. Amit Kukreja, who's a SEBI-registered investment advisor and founder AmitKukreja.com. Also, we have Mr. Rajat Gandhi, CEO and founder Faircent.com. Faircent is India's #1 online P2P lending platform and has been there for almost 4 years now. So let me start with you, Rajat, first. Welcome to the show.
Thank you.
P2P, as we understand, it's peer-to-peer lending. But if you were to understand how exactly does it operate, and moreover, can someone actually earn money out of lending?
Yeah. So before I talk about whether you can earn money or not, let me explain what P2P lending is. P2P lending is a very simple concept. It's an age-old concept. I guess even before the banks came in, this concept was existing, wherein people lend money to each other primarily. And the way it happens is that people will lend money to each other. I can lend money to you and earn an interest rate out there. And what P2P lending now does is using technology. Earlier, people used to do it anecdotally in their communities and everything. What it allows you to do is lend money through a platform, through an internet platform to multiple borrowers so that you can build a portfolio of borrowers and actually crowdfund them to earn returns. And how do you earn returns, which was your question, is primarily there are 2-3 things why you can earn returns from there. One is all lending is based on data. So we create the borrowers and put them on the platform. So you exactly know what risk category that borrower is in. And thereafter, you don't fund a borrower fully. You only partly fund that borrower. So the power of fractionalization comes in. Wherein if a borrower needs 1 lakh rupees, you can lend as small as 750 rupees.
Okay.
And that borrower will get funded by, say, 100 lenders. And with your 100,000 rupees, you build a portfolio of different risk categories of borrowers, say up to 100, 200 borrowers. And for 200 borrowers to default becomes difficult. So these are the various risk mitigation strategies which lead to you earning monies on the platform.
Right. We'll get into the details because it sounds a lot of numbers you're talking about.
Yeah.
But Amit, if you talk about mutual funds as an investment class, it's been there for some time and it's a bit difficult to actually compare it with other asset classes, especially something as new as P2P. So if you were to make our viewers understand about mutual funds, there are different kinds we know. Equity mutual funds are there, debt is there, and gold funds are also there. What actually is a mutual fund, and who is the suitable investor for it? Who should actually think about mutual funds? And then we'll get on to the comparison with P2P lending.
Sure. So one has to understand that mutual funds is a very evolved industry. It's been there for more than 2-3 decades. It had its own inception cycle and maturity cycle, and now wherever mutual funds are today, it's a very well-established system where an individual investor invests money. The risk is mitigated. The risk of managing the fund is mitigated by the fund manager. The risk of exposure to a particular company is mitigated by the fund manager, and the expenses are also rationalized. So you have to get straight in your head that anything which has been there in the system for more than 20 years is an established system where people have built faith in it, have accumulated a lot of money by continuously investing in it. Now, if you compare that system with something which is new on the block, maybe 3 years ago or 4 years ago, we have to acknowledge that the latter one has its own risk of default. Now, if I were to compare lending through a platform vis-a-vis lending through a debt fund which has a multiple AAA rated securities, and a P2P lending platform which might be having a recurring monthly return option as well. Right. We need to do a fair risk analysis. These are apples to orange comparison in my opinion, but we still need to do a fair risk comparison when we look at the returns and making a decision. So in my opinion, I would say someone who doesn't want to take any risk but wants a little bit of a return kicker, choose mutual funds. But if somebody is willing to take a risk, understand the risk involved, can definitely get into P2P lending.
Right. You're talking about risks. So, Rajat, as you were saying, there are risks, of course, involved, but there are ways to mitigate it. If you could tell us more about the risks which are there involved, because lending itself, it's a business, it's bound to have defaults. But how actually are the online platforms, the P2P platforms, handling the thing?
Look, the very fact you call it an investment, all investments carry risk. Otherwise, it's a saving product. Okay, the safest the money is in your under your bed. Okay, so that we all know. Whether one asset class has a greater risk or a lesser risk, that's a different thing, because whether it's mutual fund, whether it's P2P lending, stock markets, property, everything has a risk around it. Specifically speaking about P2P lending, there are a few risks which are there, which is one is the default risk of the borrower, wherein the borrowers may not pay back, and the moment you get into lending, that risk is there. That's the reason you charge an interest rate.
Right.
Okay. Otherwise, you won't be charging an interest rate, because that's the one is the cost of capital, and the second is the risk around it, which determines the interest rate. That is one. The other risk is around the fraud, again, around the default and all that, and of course the platform risk would be also there. Okay, because in a long period, any exchange carries that risk, whether it's NSE or any other place. Those are platforms; they carry their own risk. Okay, and we know that there were 30 exchanges in India. Right now, only 2 operate. Okay, so if you were trading on, say, a Patna Stock Exchange, you did carry a risk out there. So that's the game across the board, and there's nothing different about it.
Okay.
Okay. If I compare with other exchanges, other asset classes, it carries the same level of risk. Okay. It's only about smart investors. We talk about them. Okay. How can they still earn money out of it? Mm-hmm. All asset classes require you to use some amount of intelligence while in them.
Right.
Okay. Moment you go dumb, they do not make money.
But there's one important aspect. Mutual funds, as Amit was saying, it's been there for some time. It's been like 30 years or so. It's taken time to actually reach out to the retail investor, and there have been some campaigns from AMFI, and regulatory support has been there. So when it comes to P2P lending, what is the current scenario of P2P lending in India?
Yeah. So yeah, time is in their favor. We don't have the benefit of time of saying we are there for 20 years, but you have to start somewhere.
Right.
But the other part is about the regulatory part of it. This is a properly regulated industry. RBI issued its guidelines in October 2017, and Fairsen became the first licensed company from RBI in May 2018.
Okay.
So from that perspective, there are proper norms which govern us in terms of reporting, in terms of prudential norms, in terms of limits. The regulator has itself created certain safeguards within the platform, like having a trustee to operate the accounts, and in case of a failure of a platform, the trustee takes over. The other part is that it has limited the exposure of lenders and borrowers on the platform. No lender can lend more than 10,000 rupees.
Okay.
Nor can he lend more than 50,000 rupees to a borrower.
Okay.
Similarly, no borrower on any of the platforms put together can borrow more than 10 lakh rupees.
Okay.
So what the regulator is trying to do is, on one hand, it has allowed this asset class to come in, or a new form of lending and borrowing to come in. But what it is doing, creating exposure limits.
Right.
So that from a regulatory point of view, you are being safeguarded from your exposure. You don't overexpose yourself onto this asset class.
Right.
And of course, slowly and steadily, they'll increase the limits. What we are hearing.
But as of now, the numbers that you're talking about, there's a cap on maximum investment by the investors and all. You were mentioning that 750 rupees is the minimum amount one can start with.
Yeah.
But if we were to compare it with mutual funds, there are some mutual funds which allow you to start with the amount of, say, 500 rupees per month.
Yeah.
So if you were to compare it for a fresher, for a beginner who wants to start investments, what would your advice be to him? And then I'll come down to Amit.
So look, 750 is the entry point to lend to a borrower.
Right.
Similarly, even in mutual funds, if you invest 500 rupees, nothing's going to happen. Okay, you will be buying a very small unit of it. Every investment class requires a minimum threshold level of investment. So in our case, what we recommend is at least 50,000 rupees you start with over a period of time. You don't need to transfer 50,000 on one day.
Okay.
Okay. Over a period of 1-2 months, you build a portfolio of 50,000 and upward of 60 borrowers. Okay. So you need to make sure that 50,000 gets deployed in around 50 to 60 borrowers. That's when your return starts stabilizing.
Okay.
Supposing you put only 10,000 rupees in 2 borrowers, then your portfolio is very at risk.
Okay.
You won't earn much of it. So it's basic maths and risk mitigation. That's why
Okay.
these recommendations come from there.
So Amit, we're talking about the minimum amount of investment which is required in P2P
Right.
lending. When it comes to mutual funds, what is the ideal advice you give to your clients or people, those who come to you for advice?
Yeah.
What should be the minimum amount which should be invested in mutual funds, and how long should one stay invested in mutual funds?
Sure. So when we look at mutual funds as a product to help you reach your financial goals, we look at all different types of mutual funds. So we look at fixed income products, which is debt mutual funds. We look at equity products, which is equity mutual funds. Within equity, we have the range of large cap, mid cap, multi cap, a value fund, consumer products driven fund, particular industry based fund, thematic fund, sectoral fund, lot of options. What is more important is to understand how much time you have to reach your goal. If your goal is 2 years away, do not take your money into equity mutual fund. If your goal is just 5 years or 7 years away, take the money to equity mutual funds. If your goal is not to have money or not to have interest coming from the mutual fund, which in mutual fund terminology we call it dividend, then let your money grow in the growth option, which gives you the power of compounding, which gives you the tax efficiency as well. So it depends on what is your horizon, what is your goal, and then we choose a product. Now, if I were to put this product into a portfolio of an investor or a client who's trying to achieve a financial goal with the investment products, I think this product has an ability to create recurring income, which means somebody who is retired or somebody who is young but has a need for passive income portfolio, this product can fit into it. But since I don't know the beta, the standard deviation, the alpha, the R squared, which are all technical ratios based on which we evaluate the product, there may not be a fair comparison how risky or how reward generating this product is. So again, goal specific, we make a decision on the type of mutual fund based on the horizon and the goal, and obviously the risk appetite of the investor that he or she has when choosing a product.
That's the main important thing. So Rajat, if we were to understand from this that mutual funds is a goal-oriented product, while we're investing, we should ideally be knowing how long we'll stay invested and what is the purpose of this particular SIP or mutual fund that we've chosen. But when it comes to P2P lending, how exactly the investor is supposed to start his portfolio, make his portfolio?
Look, all investments are goal-oriented. Okay, to say that one product is goal-oriented. So when people invest in gold, technically they say that they're saving up for their child's marriage or whatever it is, for that rainy day.
Right.
That rainy day could be defined whatever that goal is. Properties, again, have a different horizon. Similarly, stock shares have different horizons with different people. So P2P lending fits in with whatever horizon you have.
Okay.
I won't say that, supposing you have a long-term investment and you look for compounding, you can keep on reinvesting the EMIs which are coming every month on month and actually benefit from the power of compounding.
Right.
Or if you have a interest in generating income, okay, that you like income. So the only product which can generate comparable income is rent. Okay. So you want to create those income generating assets. And so these are the various, whatever the goals you have, accordingly you can tailor make P2P. It's about lending, it's an investment class. It's like
Right.
stock markets. Stock markets or mutual funds are tailor made for different goals.
But one important aspect that comes to my mind when we talk about P2P lending, if the benefits of diversification and high returns, it's all there in mutual funds. How would you tell an investor to actually make a portfolio out of P2P lending? Because this is something new, as we discussed earlier.
I never
wholesome.
recommend one over the other. It's
Okay.
a part of share of wallet, firstly. Let's be very clear. It's not that you should put in only mutual funds. Also, nobody will tell you.
Right.
You should put up some in property, gold, other asset classes, and only a portion in mutual fund. Similarly, a portion in P2P lending.
Okay.
P2P lending, you should get into while if you are wanting to generate income. That's something that's the power of this asset class. So that's the differentiator out here. It's small amounts which you can enter, and yeah.
Is there any age limit, if you're like 35 plus or say 40 or 45, should you be investing in P2P lending, or it's for everyone?
So P2P lending, you can start as per the regulations. If you're 18 plus, have a bank account, and you can start investing.
Okay.
So
Is there a maximum age?
no, there's no maximum age. You can. It's about investing money. If you can understand lending, you should get into it. And I personally believe a lot of Indians do understand lending.
Right.
Primarily, there are a lot of communities who have been lending money. So that's something which is there. They can take leverage on that.
Okay. So Amit, we've actually compared mutual funds and P2P lending on various parameters like the risk, the returns that are generated. But when it comes to the age, is there a specific age you think one should start with when it comes to mutual funds? And if you were to advise a 30-year-old person, would you ask him or would you advise him to actually think of P2P lending, or how much percentage of his portfolio should he actually give to P2P?
So my answer to this question is going to be very simple and very normal answer. First, fund your goals with secure products.
Okay.
What is more important in life is fulfillment of goals, which can happen only by fulfillment of financial goals. So the more protected you are about your asset, which is helping you reach your goal, the better it is, because at the end of the day, what matters is the joy of fulfillment, right? So when we do financial planning, we always look at what is the individual risk appetite and how close the goal fulfillment is to him. So fund your goals with all the capital protected assets. If not, then understand the risk involved by plugging in that product in your portfolio to achieve your goal fulfillment. Now, if you're happy with the downside of that product at the time of goal fulfillment, so be it. I mean, you have signed up for the risk, take it. But if you want that goals to be funded as fast as possible, and then any money that you have on top of it can go into risky asset, definitely take a plunge, definitely evaluate P2P or other products which has its own risk parameter.
But one needs to understand the idea before actually getting into it.
So I think one is understanding the risk tolerance. The other one is, I think tax plays an important role. So I want to highlight one point. So in debt funds, when you invest, you get the advantage of indexation if you have stayed invested for more than 3 years. If you invest in equity funds, the taxes are only 10% after a holding period of 1 year, subject to the first lakh, which is tax-free, right?
Right.
Now, when I have this tax efficiency in these products, I have to look at the P2P product as well from the tax angle. Now, you can argue that the P2P product has a much higher ROI, and if you look at even at the 30% tax slab, if your post-tax return is higher side than the equity, sure, it has its own risk angle to it as well. But I think since the product is in the nascent stage, it's going to go through its own evolutionary cycle. I think we need to be prepared with the surprises which may happen in this industry or may not happen at all.
Right.
We need to be prepared with the cost rationalization factors of this product and accordingly add the product, knowing that this is in the nascent stage, has its own evolutionary cycle and will bring its own surprises, or may bring a joy of double the return kicker that we get from mutual funds.
Right. Well, Amit has talked about tax efficiency. If we are to talk about P2P lending, what exactly is the tax structure like? I mean, I would like to know from you, how does the tax liability play in case of P2P lending?
Yeah. So the tax liability it goes as part of your other incomes. Okay. And of course, tax plays a major role, as Amit was talking about. In my mind, but there's one more aspect which, if you see market-linked products vis-a-vis P2P, P2P doesn't have any market-linked in the short-term risks. Okay, so on the face of it, it may show that your tax efficiency is out there, but you lose a lot of capital because of the markets, which typically a retail investor does not understand. Okay, even the debt funds out there are driven through the market. Okay. Whereas out here, it's a very specific, if you've lent out at 20%, it means 20%. Okay. Unless there's a systemic risk across the country in the economy, which happens with big job losses, where the platform is not, a lot of people are not able to service their loans.
Okay.
So on a daily basis, your returns don't go up and down, okay, which happens in the market-linked products or even
So does an investor know in advance before signing the loan agreement that this is the percentage I would be getting out of this
So
particular
the only
loan?
risk once you sign up and you lend money is the default risk.
Okay.
So most Indians, or most, at least in India, retail investor does not understand the market risk as such. We all get confused when the market is going one way and the macroeconomic data is showing something else.
Okay.
Right. Now, which a retail investor is not able to time, or most time they are not able to time. Okay. So that risk has to be incorporated in the other returns also, so which are through the market. Okay. Whereas out here, you exactly know what returns you are going to get and what is your tax liability. Okay. So these are the pros and cons. I'm not saying one is better than the other.
Right.
What suits one person better with him is fine for him.
But if we were to compare these two investment options with the existing ones, and specifically the ones which are more popular among Indians, like you say FD or PPF or NSE, different categories have their own fixed returns. So in P2P lending, what is the possibility? Like how much return can one
Firstly, I will
invest?
not compare it with PF or PPF and
All these
that,
are different.
or PDs or fixed deposits and all that, because they are actually capital protection saving plan. Out there, the capital is totally safe, and the agenda for that is different. It is for a rainy day where you want your principal to be there, and typically Indians used to do that because our per capita income was too low. Okay, we are a $1,800 economy. We were 5 years back at $1,000 economy. So you are earning that much only. So whatever our saving rate showed 25%, but it was on a very small base. We used to earn 50,000 rupees, right?
Right.
So first thing is to save that money for a rainy day, because actual money what you're saving is 5 to 10,000 rupees only, right? Now is the time when why have mutual funds or other asset classes taken a boom, because now you have surplus within saving, and that's what you have to start investing, whether in property, gold, mutual funds, or your P2P. So they are all the similar risk category asset classes.
But if we were to actually understand what would be the net returns, if we consider inflation, which is very an essential thing to understand here, what is the expected rate of return out of P2P? If somebody is to make a portfolio, how much can he expect?
So our data which shows that on an average, all our lenders for last 4 years, it's a 4-year data, I can't compare with the 20-year data,
Right.
is 18.5%, around 18 to 18.5% after defaults.
Okay.
And fees. Okay. So that's the data. There are lenders who have invested more than 1 lakh rupees, more than 60-70% earn upward of 20%. But out there they are involved much more while lending money, evaluating borrowers. They have a strategy to lend money. So yeah, it works for them.
Okay, but also we would like to understand about the liquidity aspect. We talk about other investment options like FDs and PPF and everything. All of them, they carry a lock-in period.
Yes.
When it comes to P2P lending, is there some kind of a lock-in, or for how many months, or what is the duration one has to keep its investments locked in?
So there's no lock-in period per se, because whatever you invest, these are independent loans which take place. That the money starts coming back next month onwards as EMI and interest payments.
Right.
But you are locked in for that duration of that loan with that borrower. So there's no way you can say you can recall money from that borrower, because you won't be able to pay back the full amount. So it's a mixed, I would say liquidity is medium, because you do start getting the income next month onwards, but the whole capital doesn't come back. You can't suddenly say that I want to liquidate the whole capital. I want the full capital. So it's a mixed product from a returns perspective in terms of liquidity, but that's how the product operates.
Okay. So Amit, we're talking about different investment options, be it PPF or fixed deposits or mutual funds. In specifically mutual funds, how about the liquidity situation? Can the investor redeem the funds anytime, or is there some kind of a lock-in?
See, mutual funds have a huge advantage of liquidity. Right. Now, unless you have got into a close-ended product, all mutual fund schemes are mostly by far open-ended schemes. You can take out your money provided you pay the exit load, provided you pay the tax liability that you incur because of the capital gains that you realize by selling the mutual funds. So that liquidity gives an individual a capacity to deal with a contingent situation in his life. So mutual funds give that comfort of liquidity, and it also gives the kind of comfort of redemption in your life situations if you are hit by a problem in your life. So yeah, very liquid, very structured, mitigated from the risk point of view as a product.
Right. So Rajat, if we were to compare it on the liquidity parameter, would you say that mutual funds score over P2P lending, because there could be an emergency with anyone?
Yes, of course. There's no debate about it. Mutual fund and stock markets are the most liquid asset classes. Yeah, so there's no debate on that.
Right.
You can't get more liquid on more than that.
But I would like to know, as he was mentioning, if one were to redeem the mutual funds, he has to pay some kind of an exit loan or something.
Yeah.
That depends on the scheme also. But in case of P2P lending, if somebody commits for a 12-month loan, and in case there's an emergency with him and he needs to get the funds back within 6 months, so is there a penalty which is charged on him?
No, there's no charge. The borrower is not charged any penalty unless
the investor, right.
Investor has no. He can't recall the loan.
Okay. So once there's a commitment, he has to follow the 12-month.
But he starts getting the income every month onwards.
Okay.
So yes, there is a liquidity event being created in P2P. Okay. But if you are asking, is 100% liquidity? No. Okay. Now, the stock markets and mutual funds are highly liquid. But most asset classes which are income generated are not liquid. Whether it's rent, or any other asset class which is comparable, will not be that liquid, because you are getting an income, some liquidity in form of income.
Okay.
Right, that's the thing.
Okay. And also one important aspect is the compounding interest. If you could make the viewers understand how the compounding thing happens in mutual funds, and then we'll go back to Rajat on this.
Sure. So, basically compounding means when you're earning interest on interest. That happens when you don't withdraw the interest that you have earned for a specific holding period. Now, if you add to it the joy or the benefit of tax efficiency, where the interest on interest is accruing, and the earned interest is basically, or earned dividend which is getting back into the mutual fund asset value, is getting tax exempted as well, then it creates miraculous growth in your portfolio.
Okay.
If I compare that situation with this with P2P lending product, I think if they don't have the growth option, but they have a high payout option. Now, with that high payout, you can either reinvest back into the scheme, or with that high payout, you can reinvest that money into a more conservative scheme, so that you basically mitigate the risk of this product with the conservative capital protection with the alternative product. Or you have used this payout to take exposure to equity scheme or debt scheme or any government-backed product.
Right.
So I think even with the high-risk product, there is a high reward, but there is also an opportunity to mitigate the high-risk product with the rewards that you are earning from that product.
Right.
And diversify your portfolio as well. For somebody who was bought into this product, who really wants to do this, and he wants to start his portfolio story with P2P, sure, he can do that, but at the same time, he can build the risk mitigation strategy by entering the earned interest money into other products and create a diversified portfolio.
So diversification is the key. We'll talk more about diversification, but just to add a note on the compounding benefit, how does that play in P2P lending?
It's all about compounding only. I think that mutual funds and stock market, especially mutual fund, learned it from the lending business only. The power of compounding, which was never there earlier, and that's what has benefited them. So the concept of compounding is primarily from lending.
Right.
Okay, and if you see lending, actually it's the riskiest class of investment is your stock markets, of investing in startups and those kind of things. After that, in public markets. So when we got into this business, we are not primarily from the financial services business. When we got into it, and we found that lending as an asset class is the best kept secret. Okay, from normal individual people. There are more laws which control lending than borrowing worldwide, and there's a reason, because it leads to high. It could lead to high interest rates and very high income for the money lenders. And we've seen throughout the history, there's movies being made around it, that money lenders do make a lot of money, and they are hated about it.
But all those were unregulated lenders, but they're shown on.
So it's not about unregulated or unregulated. Right. The point is the asset class has value. Okay, they'll only make money whether regulated or unregulated there's value being created and the returns are there, right? So that's on a separate note, I'm just telling you about and it has comparatively lower risks, okay, in terms of, because there's an asset, there's a contract which gets signed between the lender and the borrower. It's an IOU, it's a debt instrument. Whether the markets go up or down, that instrument remains for the life with the borrower.
Okay.
Okay, till death does them apart, and after death also. So I'm getting a little technical on it, but that's the reality of this asset class. And people who understand this asset class do earn a lot of money out there, and we know the banks, the way banks make money.
So in case somebody lends for say 12 months and he starts getting the EMIs from next month onwards, you're saying that he should reinvest that money
both the
in
principal
a
and the
different loan.
investing.
Okay.
And we have seen how banks make a lot of money. Faircent says that we convert every individual into a bank.
Okay.
Okay, that's our motive. We give you the full spectrum of banking.
So there's another aspect to it where you're actually helping out people with
I'm
our
saying
surplus
from a
money.
lender perspective,
Right.
the way a bank does everything, we help you do as an individual. Because at the end of the day, banks are lending money through your money.
Right. Correct.
And so the way we see it, that can we help an individual earn like a bank? Okay, and we all know banks make a lot of money as long as they're conservative and they don't take undue risks. So if you don't take too much risk, you'll make a lot of money. Whereas in other asset classes, you have to take a lot of risk to make a lot of money.
It's time now to take up your questions. So the first question is from Ramdas Acharya. He wants to know how safe are these investments and what is the liquidity of investment in case of a premature withdrawal?
Yeah. So as we had discussed it earlier also, the safety aspect or the risk aspect is as same as any other asset class which you would be investing in. The key factor is before entering into any of these asset classes, my recommendation is, even with P2P, it's a new new asset class, is to learn about it, get yourself educated and then start lending money. Our data shows that it's as risky as any other asset class, but it has to be seen, but we do not have data beyond 4 years. But that's enough data for us to conclude that. On the liquidity aspect, as we had discussed earlier, compared to any other, say, a stock market, shares, stocks or mutual fund, it is little less liquid, but you have a liquidity event happening every month, wherein you start getting income back. So yeah, it's a mixed bag with P2P.
So Amit, there's a question for you. After this whole discussion, Mr. Kiran Sumbe, he wants to know which one is a better option. Is it P2P or is it equity?
My question back to Kiran is, what goal are you trying to fund? If a goal has a horizon on her side, then she can take an exposure to P2P or equity, understanding the risk tolerance or the risk or the downside of the investment. And if her goal is nearby, like just a couple of years away, then it is more important that she protects her money rather than tries to grow with the risk. So it's not an easy answer, I know, but how important the goal is to her, that decides whether she should be investing her money.
There's a question from Piyush Sharath, and he says that he's investing for the first time. So should he be actually looking at P2P lending as an option, and will his investments be safe?
Yeah, so the question about first time, I think what is your, as I earlier said, that you need to educate yourself. Please visit faircent.com. No, I'm not trying to plug out here, but you'll have to visit out there. There's a lot of blogs out there. There are a lot of resource center, knowledge center which we have. We have a lot of videos. Learn from that. We exactly tell you how to lend money, what are the risk mitigation strategies. And once you do that, I think it's a great asset class to enter. Because it's not something very new. Lending as a business, it's the second oldest profession in the world, and it's not that difficult to learn. So as a smart 24-year-old, I think he can.
Sartaj Hussain has sent us a question. He says that he's a postgraduate student and right now exploring different ways to grow his money. Would you suggest him to invest in P2P lending, or he should start with mutual funds? What would be your advice to him?
Since he's a first-time investor, I would recommend to him that he starts investing with the capital protection mindset. You all must have observed these days the first-time investors in mutual funds have started withdrawing money because the ROI that they were witnessing 2 years ago when they started and the ROI they're witnessing now, there's a huge difference. It's been an eye-opening experience for all of them. So they're withdrawing money, fearing that there might be a downfall in their investment money. So there is a money psychology that comes at play, right? So we all need to understand that. For Sartaj, since he's a first-time investor, my recommendation is that he starts conserving his money by taking lesser risk. However, if he wants regularity of income, which is one of the great characteristic of this product, then this product might fit his portfolio, because what he can do with the interest that he's earning, he can redirect the interest part of the investment into capital protection scheme or product, which could be a government backed product or a debt fund, mutual fund, or a bond, and then gradually diversify the portfolio. So it could be a great strategy for Sartaj, who's a first time investor, to start learning the diversification of portfolio as well as understand the recurring income opportunity and the power of compounding by creating a portfolio by investing in growth options.
It's been a great discussion on P2P lending as well as mutual funds. But before we conclude, I would like Rajat to say a few words.
I would only like to say that it's the lending is the best kept secret amongst the asset classes. Now it's open to individual lenders to start lending. Please log on to Fairson and you can just start making some good money, but educate yourself before you start lending. That's my only advice. Please read up before you start lending money.
So Amit, it's been a great discussion. Thanks for coming and making out time for us.
You're welcome.
What would you like to say to the viewers who are watching this show about both the investment options?
I would always reiterate the same message. Money is earned through a lot of hard work. So don't invest your money without understanding the risk involved. Create a balanced portfolio. If you're a first-time investor, understand the risk, understand your life goals. You need money for your goals like buying a car, buying a house, getting married, raising children, creating their education corpus, creating a retirement corpus. So you do have very well-defined goals in your life. You just need to plug in the right financial products to help you achieve your goals. If you can expedite the goals, fantastic. If you can't, then make sure that there is a backup plan. So create a balanced portfolio like you create a balanced perspective in life.
As they say, there are no bad investments, only bad investors. Experts suggest it's about your diversification, your strategy, and your understanding of the concept before you get into any kind of investment. Thanks a lot, both of you, for making a time for us.
Pleasure.
And for this very enlightening discussion. Thanks a lot.
Thank you.